Good afternoon, everyone. It's generally dangerous to do post-lunch sessions. People are either hungover with food or hungover with alcohol. But having said that, I think we have a powerhouse of knowledge here. We have Dinesh from Dolat Capital, Hemant from Neo, Suyash from Singularity, and Karthik from Sundaram Alternates, the four horsemen, as I call them. And of course, the stable keep, that's me. So the panelists on stage as such cover the entire alternate ecosystem in India, and it's a very evolving and very hot space right now. And I've been having conversations offline with them to understand they're really differentiated and each of them bring unique perspectives on the market. So it's going to be knowledge packed, so let's shake ourselves out of our slumber. So to kickstart, I think we have a common theme question that we are going to ask each of the panelists, and you could give a sense of what you think about this. So to begin, could you all give a basic product surface dive in as to why allocating money to each of your product segments makes sense, and what does a product segment do? And also, can we sort of combine that with how is the ecosystem, basically, how is the country where you're investing, how is India doing, and how are the existing market rhythms? So I'll start with Dinesh.
Sure. So, good afternoon, everyone, first. So, the question was why allocating money to a product like ours makes sense at this point of time. So, I'll take that question first. So, we run an absolute return fund. The aim of the fund is to protect downside capital. It works as an excellent hedge to any portfolio. It's an extremely low beta fund, 0.1% since its inception. It's also a multi-strategy fund where we are able to capture opportunities on the upside and the downside of the market. So a low beta fund working as an excellent hedge, able to deliver returns. Just to highlight the returns, we've delivered about 17.1% last year and 11.4% CAGR since its inception, which is 3 years. The fund is not even aimed to deliver high returns. It's aimed to deliver absolute returns, and it's aimed to protect downside. It's aimed to also integrate into a portfolio as a hedge. The ability to capture the opportunities on both sides of the market is the speciality of the fund. So I'd say that irrespective of market conditions, in fact, our fund relies on two strategies: market-related strategies and market-agnostic strategies. We'd like to call it a hedge fund, but there's no nomenclature in India to call it a hedge fund. So we are an absolute return fund under the long-short category as a nomenclature. We act as a perfect hedge. I know I'm being repetitive, but that's what it is. So today we've heard about various sessions on the market and outlook of India and how positive India is. I'm not going to cover that because let's assume that we all believe that India is a great place to invest, and we want to take advantage of the fact that over the next 5 years we'll make a lot of money in the Indian markets. To be able to do something like that and to be able to take aggressive calls on the market, it's only sensible to have a natural hedge in your portfolio. And I think this category itself should be an asset class by itself. Products like these should be an asset class by itself. So, so in conclusion, basically allocating money to products like ours and strategies that like the likes of ours is just commonsensical because you want to hedge your portfolio in all market conditions. So, yeah.
Excellent. Thanks, Dinesh. Hemant?
Sure. Thank you first, PMS AIF Bazaar, for getting this done. So at Neo Asset Management, we represent the Indian alternatives asset management industry. And I was having a chat with Vignesh. Our business is the business of capturing cash flows. When you look at equity as an asset class, equity is effectively bottom line. How is PAT growing? Our business is actually capturing some numbers before PAT. So how is your revenue growing? Can we discount those revenues, which is a cash flow, and give it to you as a product? Can we discount your operating cash flows and make that a product? So basically, we are in the business of alternatives, okay? Just think of a building which is generating cash flows. We want to annuitize that and give it to customers. Think of an operating road asset. We want to buy that and give that to customers. Think of a company which is generating cash flows. We want to give credit to that, earn that interest, and give it to customers. And globally, these asset classes are very large. Dinesh obviously talked about hedge funds as a category. At Neo, we represent the world of private credit. A lot of you would have heard this term. Basically, we give credit to companies on a bilateral basis. And we represent the world of real assets. Think of any asset that generates cash flows. We want to own those assets and basically package their cash flows and give it to customers. The important thing that I want to say, a lot of, I think alternative itself is a very fancy word. Honestly, I think what we all are doing has existed in the world for decades. The business of giving loan to a friend has existed on a bilateral basis for centuries. The business of buying solar assets has existed. It's just that we are putting it in a far more regulated, institutionalized format. The last thing I want to add to this group is an interesting data point which has also stunned me quite a lot. Why this asset class is very important. So obviously in India, we are at a very nascent stage. Like everything, we are underpenetrated. We are underpenetrated in alternatives also. But if you look at the West, because that is where you have to look for inspiration, the large Canadian pension funds, somebody like a CPPIB, which is Canada's second or third largest pension fund, you know how much is their allocation in alternatives on their total portfolios? Northwards of 60%. Northwards of 60%.
Wow.
They run $500 billion of assets. 60% is the allocation to alternatives. And the most mind-blowing number, in the last decade, on $500 billion, they have generated 11% compounded dollar returns. So just clearly tells you when the world's largest investors are allocating to this asset class, and we at Neo are representing India in this asset class. We are basically showcasing the world that India also has these asset classes. They are actually far more nascent. You can make fabulous returns in India. So there is a business of equity which thrives on bottom line. There is a business of private credit and real assets which thrives above the bottom line. And that is our business model in a nutshell.
Excellent. Karthik.
Yeah, good afternoon, everyone. I represent Sundaram Alternates. I will echo a lot of what Hemant said. We, actually technically are the youngest in a century-old business. So we are actually eventually owned by a AAA rated entity, Sundaram Finance in India. And in Sundaram Alternates, our business is twofold. One is an extension of our listed equities business, where we have bespoke, customized strategies. And the business that I run, which is the private credit business, which is currently close to about 3,000 crores in assets under management, is all about generating 18 to 20% yield on senior secured investments. That is our business. Now, within that, we run two strategies. The first is a mature strategy, in my opinion. We are on currently Fund 4 of our real estate lending business, a business where we've done 3,000 crores of deployment across 45 transactions in a particularly difficult vintage of the last 5 years. We've lost zero capital, generated portfolio returns of 19 to 20%. Our investors are currently making 17% returns, in their hands from our funds. So we believe that if we are able to generate interesting opportunities where we provide liquidity for rates, our investors in turn will benefit, with significantly higher returns than what are typically considered as fixed income benchmarks. Now, within this, there are three common threads that run through all our private credit offerings, whether it's real estate, mid-market lending, which we are in. We're also going to get into special credit opportunities, listed corporate bonds. Are three things, which are important for you guys to take away. The first is that we only do capital protected investments. We are senior secured, we are diversified, we run hard asset mortgages, cash flow traps. So essentially the focus on a Sundaram sponsored fund is the highest on capital protection. That's number one. Number two is a high visibility of returns, which means that our underlying investment cash flows, like Hemant, we're also extremely focused on cash flow backed exits. We do not rely on market correlated events. That reliance has to be extremely high in terms of being able to exit our investments. So effectively 100% of what we do are securitization transactions based on underlying cash flows. The third is the concept of risk adjusted return. I think everybody since morning has spoken about RAR. Our definition of RAR is very, very narrow in the sense that what we believe is that if we are running credit funds, then the underlying risks, regardless of the instrument that we use to invest, also have to assume pure credit risks. So, we can't be taking early stage risks, quasi-equity type risks. So effectively 100% of what we do, and since in this panel I'm representing the sub-asset class of real estate, 100% of what we do is brownfield projects, so we don't end up taking land risks, pre-approval risks. So effectively, everything that we do is backed by a high degree of sales velocity, visibility of cash flow, which will exit us. At the same time, what we also do is from a mitigation of sales velocity point of view, we have multiple projects on every single deal that we do. So even if the velocity is low on one project, the other project cash flows come in and pay us down. So in this manner, I would say since we began this business towards the fag end of demonetization, and then we had multiple events, including the introduction of RERA, which I think is significantly beneficial for the real estate industry. We also had working capital dislocations on account of GST. Of course, we had the ILFS collapse and the subsequent domino effect on the NBFC industry, and consequently refinancing. And then we had the 2 COVID waves. So everything that we did not ask for, we got. And our funds were birthed, harvested, and returned with the returns that I mentioned during this vintage. So our underwriting thesis has exhibited a pretty strong resilience to materially adverse credit events. And our investors have reposed faith in terms of almost a 60 to 70% investor retention from Fund 1 to Fund 5, which we are in. Just to juxtapose, because Vignesh's question was also, what does this all mean in the context of India and real estate? Few data points. First is the fact that, if you look at contribution of real estate as a percentage of GDP, from a minuscule number of less than 0.5 in 2000, we're 20 years hence close to 13%. Consensus market estimates point to a doubling of the real estate contribution towards GDP over the next 15 years or 20 years. So in terms of sustainable demand for capital, we seem to be in a space which is constantly generating capital demands of between $8 and $10 billion a year, not to mention capital required for dislocations, correcting issues, baggages, and so on and so forth. So we think it's an extremely sustainable demand industry from a franchise perspective. Within that, real estate also wraps a lot of what equity investors typically speak of in terms of typical features that drive Indian GDP, whether it's middle class consumer. We focus 100% on middle income segment. We are not in luxury. We focus on 50 lakhs to 1.5 crores a unit. We focus on real estate because it's also a proxy for the infrastructure space. It is also a driver of credit in the business. And to Hemant's point, interestingly, the other aspect of what he pointed out as we look to the West is a very, very significant momentum shift that's happening in India. If you look at the US, roughly 80% of all risk capital requirement is actually met by non-banks. Banks finance traditional forms of financing, whether it's personal loans, infrastructure loans, and so on and so forth. So a lot of the risk capital in the US markets come from non-banks. In India, the ratio is exactly the opposite. 20% of risk capital come from non-banks and 80% come from banks. So there is a very, very sure and confirmed invert towards risk capital moving to non-banks, which is the proliferation of the AIF industry, which 10 years ago was nothing. And today, as my colleague Vikas pointed out in the morning, it's a 10 lakh crore industry, regardless of category and so on. So we are in a space where there is sustainable demand, and our product is designed regardless of what strategy we follow, and particularly in real estate, to generate high gross returns, which the math points out, on a dollar-adjusted basis, we will still end up with double-digit returns for our investors in this part of the world. So that's what we do.
Excellent. The PE guy, over to you.
Hi everyone. I'm part of Singularity AMC. We are a growth stage private equity fund promoted by Mr. Madhu Kela, who used to head Reliance Capital and Reliance Mutual Funds before. While everyone else that I've the good fortune of listening to today have been talking about finding the right company and right investment, I think our job is to help build the right companies. So the stage that we invest in is when typically, like when the companies are 3 to 5 years since their inception, when they have done about 100, 150 crores of revenue, have found some sense of product market fit. So they have found the right market, they have found the right product to enter the market. Where we come in is then help them grow and create a repeatable motion so that they can really enter the compounding journey that we benefit in the growth stage, late stage, and public markets. I think we have been a public market investor as a group for the last 30 years. And what we were seeing across the globe was that a lot of value capture happens before the companies go public. If you see last 3-4 years, a lot of companies like Zomato, like Policy Bazaar, etc., have gone public, which have created maybe 50-60 billion of market cap today. A lot of the value between the, say, $50-100 million valuation typically at which we enter in, to that $40-50 billion growth journey happens and gets captured in the private side. So that's where we operate in. Our experience has been that if we can help and guide the promoters in the right go-to-market, in how to think about the right products, how to think about the unit economics, how to think about the cash flows, a lot of the mistakes that typically founders do can be avoided. And again, the growth journey can be significantly accelerated. So I think that's what we believe we help the founders achieve. This is on a higher end of the risk spectrum. That's why the rewards are also higher. So we expect anywhere above 25 to 30% kind of IRR, gross IRR, on a INR basis, and maybe 22% upwards on a dollar return adjusted IRR. I think India is, I think multiple people have talked about the India opportunity. What we are doing at the stage that we are investing is we are seeing what will happen in the next 5 to 10 years. And I'm continuously every day that gets me out of the bed to see the amount of excitement and the quality of the promoters and the founders who are building these businesses. Whether you talk about fundamental things like energy, you talk about solar, wind, renewable energy, energy storage, electric vehicles, the kind of segments that, and the kind of promoters that are coming in. Or you talk about more deep tech innovation segments, which is very important for India to maintain 7% plus, GDP growth. It's very important that we promote and support innovation continuously. And that will only happen if more smart founders come in early and help companies, help in the company building. So I think that is shifted in the last 16 years since the private market has evolved. There are a lot of successful founders. So for example, one of our sponsors is Mr. Mithun Satcheti. He built the Carrot Lane business, one of the most capital efficient examples that we have seen, with a 400 crore capital gone into the business. They have created a 16,000 crore outcome, and they just sold to Tanishq. So the knowledge that has been being built by these kind of founders, what to do, what not to do, and that being transferred to the next generation of founders and promoters, I think is the most important thing that we can do for the long-term growth of India, for us to be able to achieve that.
Wonderful. So I think we sort of covered the segments and the India story. So to get to more specifics, right? So Hemant, I'd like to start with you. See, the alternative investment class is actually scaling, rapidly both globally and in India, right? What do you see as the critical driver of this growth? And also, what are the kind of asset class options that people look out for?
I think one of the reasons why, so fundamentally I believe alternatives, as I told you earlier also, um, it's just a fancy word. It's existed for decades. I think what is happening globally, banks are moving out of non-traditional sources of financing, and they are heavily focused on retail lending, which makes this void for asset managers to actually go and do non-traditional forms of financing. So a bank cannot, so for example, if the government of India builds a road asset and the government of India wants to monetize the asset, which it wants to, right? Because it can't hold the asset on its balance sheet. Who will buy the asset? Banks can't buy it. The obvious people who will buy it is asset managers on behalf of their clients. Similarly, there are several credit situations in which banks cannot do a transaction because they cannot structure a transaction. They want quarterly coupons by default. If, for example, your borrower says that give me a 6-9 month resting period and then give me a most bespoke structure, banks will not be able to do it because they are accountable to equity investors. So basically, I think this entire move to alternatives is effectively driven by banking channel taking a sub-seat and asset managers taking a higher seat. And you know, one thing I want to tell, it's very interesting, this is one of my fundamental beliefs. I think the entire world of financial services is what? You are connecting the money savings to investments. I think financial services is about connecting a saver's money to investments. There are 3 ways you can do this. There are 3 vehicles to do this. One was banks. You give money to a bank, you make FD returns. But as a saver, you are giving money to a bank, the bank is investing on your behalf. The second is asset managers. You give money to an asset manager gives you the returns, he charges fees. And the third is insurance companies. I think the last 40 years, 50 years, the pendulum has swung from banks globally, and not only in India, globally, to asset managers and wealth managers. If you look at Blackstone, Blackstone is an asset manager. It trades at 30 PE multiple. JP Morgan, the world's best bank, trades at 12 PE multiple. Basically, the market is telling you something. The market is telling you that asset managers are the new banks. And I think that is something that is very interesting for people sitting in this room, because you don't need to give your money to a bank who is finally an intermediary who will put that money to somewhere else. You need to give that money to asset managers who will give you the returns on those assets, right? So we are in this business of alternative lending, alternative monetization of assets, which we want to offer to clients. And this is a very large industry growing rapidly in India. Sorry, what was your second question, Vignesh?
Are investors looking for asset class options?
You know, I told you the data, CPPIB, 60% in alternative assets. It's a crazy number, you know. Clients in India are currently still at 5, 10, 15, 20, you take any number. I think people over a period of time develop friendliness with asset classes. Equity is an asset class. I sometimes feel that the client can also probably talk about an equity stock maybe as much as the fund manager. And that is because 20 years of experience has gone into it. I think the asset classes that we are talking are probably at a stage in India where after 15, 10 years, clients who embrace it now will get the benefits of it. So what do we do? What we offer? In private credit, we are offering non-correlated returns, right? We are offering regular income strategies. For example, the Neo credit fund that we run is just one of the credit funds. That's a special credit strategy. It's trying to deliver 20 to 23% gross rupee returns, 4 to 5% quarterly coupons, right? So basically we are saying, move your money from FD, move your money from basic fixed income and divert your money to far more productive assets. The other strategy that we run is, so many roads, so many solar plants are getting built in India. Who will own those roads and solar plants? We want to own those roads and solar plants, and whatever cash flows are coming, we want to give it to our investors. By doing that, people can end up making 18 to 20% gross IRRs. And just think of it beautifully. The government of India is giving you a contracted cash flow. NHAI gives you a contracted cash flow on which you can make 18 to 20% IRRs. People are betting on stock markets, which is also a cash flow, but a volatile cash flow. So you have a contracted cash flow coming from government. On equity, you have a volatile cash flow on which you expect to make 15%. So the idea is that there are a lot of choices available. I think the world of investing is opening up dramatically. And I think it is for investors to embrace some of these newer options which they have access to.
Fantastic. I think I'm going to steal that term. Asset managers are the new banks. I think that is mine now. So, excellent. So, over to Dinesh. See, you are a long short strategy guy, correct? So, you told us that it potentially sort of mitigates the risk of losing money. But can it actually arrest it entirely? And are there any limitations to this, to the effectiveness of this strategy? Because from what you're saying, we can't lose money.
So yeah, I did say that you can't lose money. So to answer that question, right, let me first highlight what a long-short strategy aims to achieve. The objective of a long-short strategy is to mitigate volatility right through all the phases of the market and take advantages of the upside and the downside in the market. Now it's the fund manager's ability to capture those nuances and deliver returns as per the strategy of the fund. Long short is a very broad category. Now, however, there's always a however. And however, there are these unprecedented times. And to give you a few examples, if we go back to the 2008 global financial crisis or the more recent 2020 COVID pandemic, what happened during these times was that correlation between asset classes completely broke down. So during these periods of time, equity and debt both gave negative returns. Now, in these periods, long-short strategies tend to lose their efficiency a little bit. It actually boils down to the risk mechanics that are embedded into the construction of the fund. And also, different fund managers try to capture different objectives from a long-short strategy. Like I said, ours is an absolute return strategy. So we are aiming at protecting capital first and giving you absolute returns. We are not trying to give you a nifty benchmark return or create an alpha over the nifty. So here the risk mechanics may allow me to capture maximum downside, even during these unprecedented times. However, a long-short strategy that is actually trying to create a nifty-like return or an alpha over the nifty may not protect, for the lack of a better word, maximum downside. So, in a sense, a long-short strategy is supposed to be a hedge and deliver steady returns. But during these unprecedented, rare times, sometimes, and again, for very limited periods of time, you may see some stress on these strategies.
Understood. Excellent. So, Karthik, so real estate has actually been a vehicle of interest throughout, right? India, Middle East, everywhere. Tell me, so it's a long gestation period, correct? And there are a lot of cyclical, like he was talking about cyclical act of God kind of things that happen. How do you protect the interest of investors? Is there any risk management practice that you have? And has the practice and scrutiny improved over a course of time?
Okay, it's a very interesting question. There are actually several subparts to your question, Vignesh. Speaking for ourselves, first of all, it's a question of allocation, right? I mean, part of that question is, can somebody just go out and buy an apartment in Mumbai, which is considered to be the epicenter of everything that happens in the country because it's a commercial capital. Interestingly, I had this exact conversation with one of our investors in one of our earlier funds where I went to pitch first about a fund. And he said, why should I put money in your fund? You'll go lend, and I don't know what you'll do, who you'll give money to, whether those returns are realizable. so on and so forth. I'd rather go buy an apartment in Juhu. Literally, I mean, so he actually went and put 15 crores in an apartment in Juhu versus giving us that 15 crores. Okay? This was in 2017. Okay? Come 2019, he sold at a capital loss. Simply because the industry was going through consolidation. There were shakeouts. The top 5 lenders or financiers in the business are no longer in business. Forget about changing and going down the curve. They're not in the business. Okay, I won't mention names. So effectively, the idea of investing into hard assets, except as our own end customers who buy into homes that we finance, projects that we finance, they're looking for homes and a roof over their head. That's housing demand, that's separate. But from an investment perspective, the idea is to always now increasingly allocate to financial versus physical strategies, right? So physical assets. So the idea is to go into physical assets. So because you can diversify, you can, if you just look at this set of panelists, and I heard each of them talking about their returns, including myself, if you were to just put 25% in each of our strategies, the blended return is 19% back to you, right? Where would you find an asset that you can buy that will generate an IRR of 19% to you? It's very difficult, right? So I think that allocation decision has already been made. Now coming to investor protection, I would think that one of the single most important regulations that have been introduced in India that has had significant impact has been the Real Estate Regulation Act, which came out in May of 2018. All the developers, including the ones that we financed, were kicking, moaning, screaming, this is unfair, this, that, and the other. But it has massively brought hygiene into the space and corporatized the sector, where transparency, ability for end customers to get to their assets, delivery efficiencies, and governance in general and in specific has increased massively across the country, regardless of the micro market. So there is already a regulatory sheen, that has improved protection for investors as well as end consumers in the space by a lot over the last 5 years. In addition, speaking for our own way of doing business, real estate is an interesting space because, as I alluded to before, you can actually invest through whatever instrument you want, whether it's a non-convertible, pref share, equity, and so on and so forth. You can end up taking a variety of risks. You can take equity risks, you can take mezz risks, you can take senior secured, which is what we do. So effectively, the way we looked at the business from our investors' perspective is, again, through the concept of risk-adjusted return. So what we do is we lend. It's a bank debt. It's plain vanilla senior secured loans where we recover interest every quarter. We take an upfront fee to boost the IRR. We do 100% amortizing investments, which means that there are no funky structures in terms of back-ended payments, pay when able, profit ratcheting, so on and so forth. So effectively for us, we may give a principal morat for cash flow for a year, max. After that, every quarter we want our money back. So there is a consistent risk reduction that our investors see, also as evidence of our investments working. So that's very important for them psychologically, right? Because they're seeing that every quarter the fund is generating so much of cash, they're getting income distributions every quarter, and we're able to recycle. So the way we look at it is we're senior secured, we lend at 2 times cover at our valuations. We have cash traps across multiple projects. We take PGs, PDCs, all of that is par for the course. Everybody does it, so do we. But most importantly for us, as I mentioned before, the USPs are from a risk protection point of view, we don't do any early stage, we do 100% brownfield. And we have an enterprise type lending structure so that there are multiple cash flow streams that will pay us back. Now in this way, what we take are pure credit risks. And from that perspective, it's much easier for us to demonstrate to our investors that, this is all the risk mitigation that happens at layer 1, layer 2, layer 3. And, a lot has to happen if a credit has to go through all of this or fail all of this and finally come to a stage where we have to enforce. And if it does come, God forbid, to that stage, we've done 45 deals and, we've never lost money, as I said. If it does come, then, we have the benefit of RERA at the end of the day, and we have the benefit of IBC to be able to take a company, step into creditor rights, recover money and so on. Our intention is never to go there because we are in the performing credit space, but there is multiple layers of protection, structurally as well as by way of regulation, that, we are able to achieve. So it's a fairly unique space. where you're able to take differentiated risks and demonstrate end protection to our investors.
Excellent. So structured protection is available in the real estate segment. Excellent. So over to Suyash. Coming to what I call our segment, right? So in the PE/VC side, we have seen considerable investor interest and we can see the kind of cash flows coming in for this. In fact, even large banks are setting up fund of funds to give money to people like us, right? Where do you see investor interest from your perspective or general perspective? What are the broader themes where people are looking to invest in the PE and VC side?
So I think it's a combination of, I think I'll break it down into two things. The way we look at portfolio construction is India has two cycles, right? So a public market cycle runs complementary to the private market cycle. Today we are seeing that startup valuation or the fund flow maybe in the private side is lower than the last 3 years, right? Like average last 3 years, maybe 2021 was the highest where there was an inflow of about $75 billion. 2023, it was about like odd $55 billion odd. It is still one of the highest years, but it has gone down a little bit. Otherwise, the public side has seen an upcycle phenomenally because of the overall boom that we are seeing over there. How we are constructing the portfolio, it's a complementary of both the things. So you do 60% of the capital allocation on the private side, 40% of the capital allocation in pre-IPO or companies which will go public in the next 2 years or are public already. So I think that combination, through that we are able to maybe give good risk-adjusted returns so that you're not taking a complete risk on the early stage or the growth stage side where you would not have visibility on the exits, which has been one of the bigger problems that like one always gets asked that, India mein exits nahi hai, right? So how do you solve that problem? I think from a segment side, it's important to choose your core competence and like invest in segments that you really understand. The things that we are comfortable with as a fund are segments like consumer brands, where we are looking at premiumization of the economy. The highest growth will be happening in the premium segment. Three segments that you will kind of segregate into in the consumer side. So like, looking good, where you're looking at apparels, consumer electronics, food, where you're feeling. Eating good would be like companies which are doing better food or nutraceuticals, which is helping you lead a healthy life. So those are the good segments in the consumer brand side. Otherwise, we are investing in the entire energy transition space. If the Indian economy has to grow from 3.5 trillion to say double in the next 7 years, the power requirement, the fundamental raw material, which is energy that will go, that requirement will also double or maybe increase a little bit. So I think what will happen in the next 7 years is the power infrastructure will grow significantly. And within that also there's this transition which is happening to cleaner energy sources, right? So there'll be higher growth in solar, wind, where they go from maybe 20-25% of installed capacity now to 50% plus of installed capacity as we reach like 2030. So again, like higher than industry growth rate we will see in the power segment. Or you talk about the entire EV transition. Interesting, like, I'll give you some examples of how you can, within the same segment, if you are bullish about the theme, say the EV transition, there are multiple ways to play it, right? Like you can go and invest in a OEM like a Tata or a Mahindra, which have a huge legacy system to get over. They have to cull their ICE to kind of really promote their EV. But auto companies traditionally, or battery companies traditionally, battery OEMs are like, 8 to 12% ROCE businesses. It takes a very long time to give positive returns and it always goes through cycles. But within that as well, there will be certain segments in the supply chain of electric vehicles, for example, that you can make 20-25% plus ROCE business. And I think India, again, as we're talking about it, there's a huge India to global opportunity, where if countries like US and Europe want to move away from batteries which are manufactured in China, they have to find alternate sources, right? So if you see companies, again, no investment advice, but if you see companies like Wari, whose 80% of the business is coming from export to US. So US is very gung-ho about kind of moving away from Chinese solar cells. And a lot of that demand is coming to India. So I think that is a kind of huge uplift that we are giving to the renewable energy segment. Similar stories will kind of pan out in the EV segment. Similar stories will be panning out in the IT services segment, for example, where India exports more IT services than like a Saudi Arabia exports oil. There'll be certain interesting segments like cybersecurity, which is becoming very important. If you look at the overall software spending, there has been a downturn in the US where the software spends has gone on. But if you talk about cybersecurity, has been always a priority. They can kind of reduce their spending on any other segment, but cybersecurity has always been the top thing. And India, we are better at services than kind of products. So I think again, cybersecurity services might be a very interesting segment for you to look at. But it's always important because we have come from a family office background where we were managing our own capital to now doing running a AMC. It's very important to choose your right like core competencies and invest in those segments, or choose the right asset managers where you believe certain segments will have a higher growth than normal.
That's an excellent answer, and I think for a long time, I think the first time I'm hearing a pre-PE VC guide not mentioning AI or SaaS, so credit to you for that. I think the hard assets are going to play a excellent answer. So let's get we have 15 minutes to go, so crisp, and let's get to some segment-specific questions. I'll start with Karthik again. Why would I consider a real estate fund rather than buy property? This is a question that comes from my middle class background. I'd rather buy the asset, right? One thing. And how do you see the fractional market in the real estate space picking up?
Okay, I think I might have jumped and answered this question in my previous response. As I said, I think there is a very tangible movement from physical assets to fiscal assets that has happened over the last 5 years. Particularly because of the fact that there are multiple investment avenues that are available, including ones represented on this panel. And investors today, if you ask what is the number one primary driver, for them to go into alternatives, of course, equity remains the primary, sort of asset class and reflective of the Indian economy's growth, is to actually generate yield, which is inflation-adjusted yield. So it's a real inflation hedge that drives this. And one is not sure that if one, from a real estate context, puts all his or her money or a sizable allocation within a portfolio into a physical asset, unless it's for a roof over your head, whether that is going to actually generate an inflation-adjusted return. So it depends. It could. I'm not saying it won't, but people are looking to spread their risk and widen the eggs in the basket. So that is sort of number one. Similar to we are actually in this panel representing subclasses, so there is a very active fractionalization that is happening across each of our asset classes in India, and in fact, SEBI is coming out with regulations on it as well. So for example, in the real estate context, there are platforms that are emerging where it is possible for you to buy, for example, for check sizes as low as 25 to 50 lakhs, a piece of a commercial property. Now, I may or may not, be a fan of this because I think it's pretty early stages, and I think the risks that they run eventually, from an overall value delivery in the space is relatively high. But, there is increasing demand. If you look at venture capital, there are 7 platforms, that are fractionalizing investments into angel, seed, pre-series A, series A companies. So, that is again, very, very active, as a space. But having said that, I think in general, I think the focus for Indian sort of investors is to, if you look at family offices, so for example, speaking of our own funds, we have a cross-section of investors. We have high net worths, we have family offices, we have insurance companies, we have corporate treasuries, and each of them are driven by a separate motivation in terms of why they want to actually subscribe to alternates or private credit. It could be an allocation issue. It could be an inflation hedge. It could be consistency and stability of earnings. So depending on the risk reward, sort of thresholds and matrices, each of the, managers do have avenues, to be able to go and offer sub-derivatives of exactly what we're doing today. So that is a market that's fairly open. It's still early stages from a fractionalization point of view, but I think there is enough evidence to see that these asset classes may not necessarily be only for the uber rich, where the minimum requirement is 1 crore from an Indian rupee standpoint. It could be fractionalized and had access to by retail investors as well.
Excellent. So you should meet my dad. He still believes buying a house is good. Anyway, so over to Hemant. Hemant, we had a chat about stressed assets. The take you gave me about what is actually constituting a stressed asset today is different. So how does the market for stressed assets differ across different countries? For example, we had a chat about USA versus India, right? So, and what are some of the key risks that you see? And if you talk about risks, talk about the rewards also.
Sure. So there's a very interesting question. I think when people hear the word stressed, I think the first reaction that comes to the human mind, stressed means death, right? And I want to dispel that notion first. Let me give you two examples, two real life examples. There's a company, SR Steel, we all have heard about. Brilliant. So SR Steel was a stressed asset. Despite being a stressed asset, it was generating cash flows, right? The company was going on, it was stressed. Then came ArcelorMittal, it acquired the asset at a price. And obviously, ArcelorMittal has probably made its entire money in a 2-year payback period. Let me refresh your memory 20 years back. Many of you might not even know this. I'm sure we've heard of a company called JSW Steel. Fantastic. JSW Steel is a restructured company. I'm sure human memory doesn't even remember it, right? So the point that I'm trying to tell you is that stressed does not mean death. And in the business of stressed investing, I think we are buying EBITDA positive companies. So basically, when SR Steel was going through stress, SR Steel was still making 7,000 crores EBITDA a year. How much? 7,000 crores EBITDA a year when it was in stress, right? So at that time, if you bought the debt of SR Steel at 21,000 crores or 20,000 crores, it actually became a great asset. So the point is, I think companies like human beings go through phases in life. It doesn't mean that when you're down, you're out, okay? So that's one notion of stress that I truly want to dispel in everybody's mind. I think stress doesn't necessarily mean out. EBITDA positive companies come back because resilience of human beings bounces back. The other thing I want to add on stress, and this is another very interesting perspective. We all have heard of a company called DHFL. Great. Absolutely. Now, Divan Housing was a stressed company, defaulted, fantastic. But when DHFL got settled, on 100 rupees, 42 rupees got recovered. If you had invested 100 rupees in the bonds of DHFL, you recovered 42 rupees. But that's not the interesting point. The interesting point that I want to make is, before this settlement happened, 2 years prior to this 42 getting discovered, the bond was trading at 20 rupees, 24 rupees, 26 rupees. The point that I'm trying to make is, if I buy a stressed asset at a far discounted price, if I bought the DHFL bond, which got settled at 42, at 24 rupees, at that price, it was AAA. So at every price, an asset can become AAA. At every price, an asset can become BBB. So the two things that I do want to leave this audience with, stress does not necessarily mean death. I think EBITDA positive companies turn around all the time. There are so many examples. I can give you an endless list. Gokuldas Exports, SR Steel, taken over by Arcelor, JSW Steel, n number of examples, right? And the other important point is the price at which you buy an asset actually defines whether it's AAA or BB. So that's a little perspective on stressed assets. The only thing I think in Indian terminology, I think fortunately, globally, when people talk about stressed assets, they're talking about turnaround situations and stuff like that. You know, you get involved in a company and you want to turn it around. I think in India, we are still very fortunate. I don't think we do any of that hard work. We buy EBITDA positive companies at good prices and try to make money out of that. So in India, I think stress still just means basic investing. Buying it cheap itself is stressed investing in India. You're buying EBITDA positive companies. And that is what we do as part of our fund. We buy EBITDA positive companies. It can have an NPA tag, but it is generating EBITDA. And at that EBITDA, our debt is making a lot of sense.
Excellent. So quickly to Suyash and before I come to the Dinesh. So of late, our asset class, private equity and VC valuations have taken a great hit. What do you think are the key factors? And is this set to continue?
I think I would not want to make any blanket statements. There are always segments which have made sense in India and segments which haven't. So again, like I think you will see in this downturn also, like real assets have done phenomenally well. Businesses which are in consumer internet, like education, edtech, which like predicted that 60-70% of India's kids will now get educated online, or people will stop going to gym together because Cult Fit is there. Right, so I think there are certain segments in India, like consumer social, for example, like platforms which are created, like Facebook, for example, in India. The monetization potential is not there at all, right? Like paying potential is not there, ad monetization potential is not there. So those businesses fundamentally don't make sense. But there'll always be businesses which will make sense even in the current economy, and it has been actually a boon that, right, you're paying the right price, as Hemant was saying, that you're paying the right price in these markets. So it's a great time to enter right now. And in the next, again, like when is the time to exit in the next 5 to 8 years, there'll be again a boom cycle, hopefully in the public markets, which will create better opportunities for you to exit. So there is both a growth lever for expansion of your returns, and there's a re-rating lever as well, that you enter at a great price. We are typically entering at, say, 15 to 20 times EV/EBITDA multiple, even like profitable companies in the private markets. So you have that arbitrage always in play. So I think, again, everyone is going back to the fundamentals. Look at what, as India, what have we been really good at, and focusing on those segments. Again, like defense sector, for example, you are seeing a boom throughout, right? And that spending will only increase. And as India moves from the 5th strongest economy to the 3rd strongest economy, right? Like we always have very sketchy neighbors, so we always need to kind of keep increasing the defense spending. As India increases the regulations to make in India, there'll be phenomenal opportunities to create companies which are in drones, companies which are making fundamental assets, which are like 60-70% plus gross margin business. They will do like 25-30% plus EBITDA margins, and very capital efficient plays, right? So I think there'll always be opportunities in India if you kind of choose the right segment, because each sector will typically double in the next 6-7 years. It's about how do you choose particular sub-segments within that, where you can get even 20% or 30% plus growth per year.
Lovely. So we'll finish it with Dinesh. So what is, in your opinion, a diversified portfolio? And can quant models effectively capture risk and return?
What constitutes a diversified portfolio? I mean, if I have to answer that, and I can see that there is
The
2 minutes left.
The panel is a...
I think we'll have to take another
Okay.
1 hour to just say what constitutes a diversified portfolio, because that engages with asset allocation strategies, tactical, strategic, etc., etc. But to answer the quant part of the question, you said, is quant effective? Is that what you asked me?
Yeah.
So I think quant models have, over the last 10 years especially, shown extreme strength in their development to capture that risk-return trade-off. Quant models are today very reliable. They're accepted. Also because markets are more mature, regulation is more tight. So, and generally technology overall has become better, including computing power. So we base our models on quantitative mechanics, and I know the kind of underlying technology that goes into creating an algorithm. So quant models are extremely effective. However, at an asset class level, asset allocation class level, can I build a quant? Of course I can. And there are people who build quants on that, for that exercise as well. But today, if I have to decide whether I have to invest into the equity markets, put some money into real estate, diversify into Hemant, Suyash, Karthik, and an absolute return fund, I wouldn't rely entirely on a quant. I mean, I think a combination of a traditional asset allocation exercise along with some quant strategies in the portfolio will create a good combination. So, yeah.
Excellent. Do we have time for one more? So final question, one word. So yes, no. Does the global market influence India's own alternative asset business, or we are different? Yes, different. No, not different. That's it.
I mean, different or no?
Yes.
So
we don't have time. Yes or no only.
So yes and no.
Okay. Hemant.
No, I think that's a fair one. I'll stick with yes and no.
Okay. Karthik, break the rut.
I have to say no.
Wonderful.
To some extent, because I think India is now slowly beginning to emerge on its own. I think there's enough, even on the liability side. You know, for example, we raise most of the money in India, so that was earlier the piece which we depended from overseas. Of course, having said that, I'd love for people in this part of the world to put money in our funds, but it can stand pretty much, you know, on its own. I'm not talking about, you know, trade blocks and geopolitical events and all of that stuff. Purely financially, I think there is enough of a domestic consumption theme for India to stand on its own feet.
Excellent.
Yeah, I mean, yes, but transitioning towards no. We are standing on our own 2 feet and actually being able to supply to the world now.
Excellent. I think it's a wonderful panel. Thanks so much, and thanks to the audience. Wonderful audience. Thank you.
Thank you.